morning and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, February 18th, 2020. Time continues to fly by. Hope everybody had a nice extended weekend, but we are back in business today. Got a lot of things to go over. Let's take a look at that agenda and go through the things we'll talk about this morning. We got the daily market recap from Friday. Talking technically, I want to go into a couple articles I've written recently, and I'll go into some of the details there. Earnings spotlight, got a couple of big companies that reported not so great, but on the surface, the way the companies reacted to their earnings reports kind of interesting. It seems to be like one of those opposite days if you're a Seinfeld fan. You remember George Costanza always doing something opposite of what he thought he was supposed to do. Well, that's kind of what it reminded me of when I was looking at some of the earnings and their reactions. But anyhow, then we got upgrades, downgrades. We'll go through those. Relatively speaking, want to just talk about a couple of areas that are starting to perk up. We'll get into that in a bit, and then we'll wrap up the show as we always do with three you must see. That's three charts that just look interesting to me technically that you may want to be aware of as the day begins. Do have a big event coming up. It is tomorrow. It's a big quarterly event that we do at Earnings Beats each quarter. It is called the Top 10 Stock Picks, Top 10 Stocks. And essentially what I do is I put together portfolios at Earnings Beats for some of our members who don't like to trade as often. Try to find some of the best stocks out there in terms of their quarterly earnings reports that come in above expectations, and then also those stocks that show great relative strength. And the whole idea is to put together these portfolios that are designed to outperform the S&P 500. So anyone interested in attending, you do have to be a member of Earnings Beats for this one. But anybody who is interested in attending can go to earningsbeats.com, and this is what you will see. There will be a webinar here at the top, and if you click here to learn more about the event, it'll actually give you some information about these portfolios. So, for instance, the model portfolio that I started back on November 19th, 2018, and update the portfolios quarterly. So every 90 days, basically the 10 stocks that were in there get replaced by 10 new stocks. Always looking to try to get the best stocks in there for the next quarter. The model portfolio has produced a gain of 58.25% in 15 months. It'll be 15 months tomorrow. And that compares to the S&P 500 benchmark at 25.62%. So a lot of outperformance. And again, it's based on getting into these companies that have produced great results, revenue and earnings per share, beating top and bottom lines, the estimates that were out there. And then also leaders. I'm looking for companies that lead within their industry and also able to lead the S&P 500. In May 19th, I added two more portfolios, the aggressive and the income portfolios. You can see both of them outperforming the S&P 500. The last quarter, I did what's called, I started a new portfolio character change. So these were companies that were in downtrends or simply weren't going anywhere, came out with their earnings, beat, gapped higher, so it looked like might be a breakaway gap. So I wanted to see what it might be like to put some of these stocks in a portfolio where maybe we're getting reversals, expecting some would continue going up, some would go down. Well, you can see not a great performance for the first quarter, but I still actually have a lot of good feelings about this portfolio going forward. Keep in mind, too, that the benchmark that I'm using, the S&P 500, both the character change portfolio and the aggressive portfolio have both small and mid-cap stocks in them, not the large caps that we see on the S&P 500. And if you've been following small caps and mid caps, you know they've been significantly underperforming the S&P 500. So that's part of the reason why this is down, and then also just wasn't a particularly great quarter for those stocks. There were a couple of them that really came down and offset some of the big gains that were in the portfolio as well. But anyhow, I think looking back at these four portfolios, they've done extremely well cumulatively since their relative inceptions or respective inceptions. And so tomorrow, what I end up doing for this event is I announce the 10 stocks that are going to be in each of these four portfolios for the next 90 days. So anyway, if you're interested, again, you can go to the earningsbeats.com, and here at the homepage at the top, just click here and you can find out more information and get signed up. Also, by the way, our trial, which is a $7 30-day trial, You sign up, you do get charged the $7, but we'll refund you for a limited time. We're refunding the $7. So literally, you can try the service 30 days without any cost whatsoever, and get those 40 stocks that will be in those 4 portfolios. All right, let's move on to the market. We had kind of an interesting day on Friday, and that market was down early, and then once again came battling back. Saw the Dow Jones finish down 25 points, but the S&P was up 6, NASDAQ was up 19. Mid caps and small caps, once again, a little bit of lagging there, both down on the session, although mid caps you can see down just less than a point. Small caps, though, down 0.5% on Friday. Still struggling short term to get above that 1025 level. Real estate, all of a sudden, getting a lot of movement to the upside. And I've been thinking about this. And, you know, with the stronger economy, what normally happens in the market is that as the economy strengthens, folks want to get out of real estate. They want to get out of utilities because as the economy strengthens, interest rates go up. So all of a sudden, the dividend paying real estate stocks and utilities don't look as attractive when the guaranteed U.S. Treasury yields begin rising. Well, in this environment, and I think this is one that's going to last for a while, I think the Fed still needs to cut rates. I mean, I'm watching the dollar go up, challenging, moving to new highs. Commodity prices have been struggling. And so that's going to keep a lid on inflation. And the Fed wants to inflate. The only way to do that is to lower rates to weaken the dollar, which then in turn would inflate commodity prices. So I think in this environment, it's going to kind of be an unusual bull market, but I think real estate and utilities will continue to do well. I don't think they're going to be the best performing groups, but I don't think they're going to lag by as much as we might think, based on the fact that I think interest rates are going to stay very low throughout 2020. Technology also higher. You can see the real estate was the leader on Friday. Utilities did well, technology up. Staples also up, consumer staples. So 3 of the top 4 groups on Friday were in the defensive area. And then you've got energy as the laggard. I still like energy. I'm going to talk about it here in just a minute in talking technically, but we'll get to there in just a minute. First, let's talk about the 10-year Treasury yield. And you can see, I'll get a quick update here. It is at 1.56%. It was down as low as 1.54 earlier, so it has rebounded a bit, but it's still down almost 3 basis points today. So the 10-year Treasury yield, the bond market, in my opinion, just keeps screaming to the Fed, and had to do it quite a bit back in 2018 before the Fed finally started listening. And it seems like that's what they're doing now. The Fed keeps saying they're on hold. I don't believe they're going to be on hold for long. I think we will see a cut. And I'm going to say over the next couple of months, we get a cut. I think the market is pricing in one maybe for the summer. I wouldn't be surprised if we get it sooner, though. All right, let's move on to talking technically. And I wanted to talk today about a couple things in talking technically. First, wanted to go through a couple of my blog articles that I've written over the past couple of weeks. The first one here is an article I wrote on energy saying I thought it was primed for a big rebound. Now, I'm not saying that the energy is going to lead the market in 2020. I don't want anyone to miss, to misconstrue really the purpose of the article. What I was saying, though, is that based on the fact that I do believe that the dollar will eventually roll over, I think that it's in our best interests for the dollar to weaken in the near term in order to inflate commodities. The way that the bond markets in the U.S. and in Germany have been behaving, with our yields, performing much worse than the yields in Germany. For a while, you can see for several years, the yields were going down in the U.S., but they were going down slower than they were in Germany. So on a relative basis, when you take the difference between the two, U.S. Treasury yields were actually gaining ground versus Germany, which is an indication to me that our economy is stronger, which normally results in the dollar rising, which is exactly what we saw. But for about the last 15 months, you can see this has actually been coming down while the dollar continues to rise, which has led down here to an inverse correlation, which you can see doesn't happen very often. So I wrote the article, I thought the dollar was going to go lower. Instead, it's done the exact opposite. It's actually moved back up here to challenge these highs. I don't think that's what we want to see here in the U.S. I don't think that the Fed wants to see the dollar breaking out because it's going to put more downward pressure on the commodity prices, which in turn is going to lead to even lower inflation. So I think the Fed's going to cut. And again, some will be up in arms saying, well, the economy doesn't need another interest rate cut. But in my opinion, it's not about the economy. It's about the fact that we do have a strong economy without any kind of inflation. We have very little inflationary pressure. And so an improving economy with lowering rates is actually very good for the stock market. And I think eventually that will, well, it's not eventually, it's playing out now, and I think it will continue to play out. So, but I would be watching for a rate cut eventually, sometime this year. I believe it'll be a little sooner than later, but we shall see. In the meantime, if the dollar goes lower, that was part of the thesis here with this article, is that the dollar would move lower. And when you look at energy, energy was getting down close to some very key support levels, the XLE I'm talking about, which is the Select Sector SPDR fund. So it's one of the major sector ETFs. It was down near a key support level. Been a very, very weak performer on a relative basis to the other groups. I think at the very top here, this was a 6-month performance chart of all the sector ETFs, and you can see what was on the bottom. The only group that had lost ground was energy, down 8.6%. The next worst was materials. These are the two that are most negatively impacted by a rising dollar and would be most positively impacted if the dollar were to fall. So that's why I was making the case here for energy. Now, when we look at that energy chart and update it, you can see we have bounced. I think we were at like 52.80 in that article. I'll take a look, see where we were. 52.85. And now we're at 54.58. So we have made a move here in these past couple weeks. I think it could go higher. I would be looking up here at these moving averages, maybe even back into the low 60s. I think that energy could make that move, but it will be partly based on whether or not the dollar stops moving to the upside. And when I pull up the dollar, you can see it has, even since I wrote my article, I expected the dollar to roll over. Dollar's been going the other way. And even with the dollar going up, energy has rebounded. So if we ever actually get a drop in the dollar, I would think that energy would perform pretty well. We are at a key resistance area on the dollar. We shall see what happens there as well. Let's see. Let's look at one other article here while we're talking technically, and that is perspective. This was an article I wrote. I'm always looking at technical analysts and what they're writing, both here at StockCharts and around different areas, different websites and so forth. And I've seen a lot of folks writing and looking at what's going on in the market right now and comparing it to earlier in the 2010s, 2011, 2016, some 2015, or worse yet, going back and comparing it to the bull market that we saw in 2003 to 2007. That was a cyclical bull market in a secular bear market, which is just a nice 4 or 5 year move higher, but within the confines of a market that just doesn't break out and just, you can see a couple of really big drops in here. That is what a secular bear market looks like. These are what secular bull markets look like. And to me, this looks nothing like what we went through from 2000 to 2009. I extended out here because we don't break out above these prior highs until about 2013. And if you recall, 2013, the market took off to the upside, 2013, 2014. So, and that was kind of the confirmation that we were in a secular bull market, that we had exited the secular bear market. So I think it's really important when you look at conditions, economic conditions, also tactical conditions, that you consider what a secular bull market looks like and not compare it to a secular bear market. Here in a secular bull market, you can see that you can see the PPO broke out above anything it had seen throughout these big drops. So when you're in the middle of a secular bear market, your momentum is only going to get so good to the upside. Here you can see we actually got outside that range and broke out to 8, which we had not seen since back at the end of the 1990s. We had not seen a monthly PPO that was that high. The other thing is when you look down here at the monthly RSIs, you can see a much different picture in what the RSI does or what the RSI can do during a secular bull market versus bear market. So in a secular bull market, you're looking at a monthly RSI that typically doesn't go below 40 and can go as high as 80 or even 90. When you get into a secular bear market, you can see that RSI more evenly distributed. It goes down as low as 20, goes up as high as 80, but for the most part, just kind of goes back and forth between the 30 and the 70, which is oversold and overbought levels on an RSI. Now we're back into this secular bull market mode where you can see the monthly RSIs don't go back down anything like what we saw. We don't have these kinds of drops, and I'm not expecting any. But the whole idea here is that the RSI and the PPO, when you look at them and you look back at where we've been this century, you might think, wow, this is it. This is as good as it gets. And what I'm arguing is that no, it really isn't. In fact, this PPO reading, which was at 6.21, that is a monthly PPO, 6.21. The average PPO during the last secular bull market, the average monthly PPO was, let me give you this number, 7.10. I went back and actually did the manual calculation of every monthly PPO from 1983, basically when we broke out here, from here through the end of the 90s. The average monthly PPO reading was 7.1. We're sitting at 6.2. We're not even at the average of where we were. The highs that we saw, I mean, you can see double digits. Now, I'm not saying we're heading there on this move, but that's the potential upside that you have to be thinking about. And when you think about what the PPO represents, it's the percentage difference between, in this case, the 12-month EMA and the 26-month EMA. So if you took the 12-month EMA, maybe as a final exercise, I'll do that really quickly here. But let's go down here and let's do the 12-month EMA. And 26-month EMA, we don't need that one. And let's just, so you can see, so here is your difference. So the 12-month EMA is sitting at 3,067. The 26 is 2,883. The difference is about 184 points. If you take 184 and divide it by that 2,883, you will get this reading up here, which is now at 6 point, I can't tell what that is, 6.34. That's how this PPO is calculated. So imagine the PPO getting up to about 13 or 14, what the difference would be. Now, the 26-month EMA is going to continue rising. So as that continues to rise, tack on another 10, 12, 14% to that. And that's where this 12 EMA and then could get to. And then when you figure out what that 12-month EMA is, in order to get the 12-month EMA up to that level, we would literally need a melt up in the market. And I wouldn't bet against it. I actually think that that is a real possibility. So anyway, I just wanted to point those couple of things out in talking technically today. So let's move on. And I want to go over to earnings. So let's talk about earnings spotlight here. Got a few companies I want to just briefly go over. First is Walmart. Walmart did report their earnings this morning, a little disappointing. Only came in at $1.38 versus $1.43, and the stock's up 1%. This is the opposite thing I was talking about earlier with the Seinfeld reference. Walmart, yeah, missed on their earnings, but stock's still up. Now, when I look at this stock on a relative basis, we probably could have banked on maybe a not so great report. Look at the last 3 months on Walmart taking this big drop versus personal products. So it's been a very weak part of the industry group. It's been very weak relative to the S&P. So I'm not surprised that we have this that we had this miss. Let's see here. Let's go with Medtronics. All right, Medtronics, MDT. This one came out with a beat, $1.44 versus $1.38. Stock's down 3%. So Walmart missed and is up in pre-market. Medtronics beat and is down in pre-market. So just looking at that headline earnings per share number doesn't tell the whole story for a number of reasons. It could be based, different reaction could be based on guidance, which may not be good. It could also be based on the fact that a stock, even though it comes out with good numbers, maybe it's already priced in I mean, we've seen Medtronic's run from 105 back at the beginning of November to 122.5, put in a double top. Maybe it just needs to, sideways consolidate for a bit. But it is down 3%, which is going to be about $3.5, about $3.50. That would take us back to about 114 or so. So we're going to open back down here. I'd really like to see a hollow candle here on Medtronic. But right now, it is what it is. I want to look at one other one. AAP is getting a really nice reaction to a strong earnings report. Came in $1.64 versus $1.36. Stock is up almost 7% pre-market. We do have a double bottom. This has not been a very good stock. In fact, I would not have been looking for these kinds of results. Maybe we'll get a change of character. That's how this is actually how that fund that I talked about earlier, how I find stocks that are looking horrible, they come out and beat, and all of a sudden they have a change of character on their chart and they start trading more bullishly. I don't know if that's what's going to happen here with AAP, but it could. All right, let's move on to upgrades and downgrades. I want to start with INFY. This is Infosys Technologies. The stock was upgraded today. It's up 1.5% pre-market. I look at the relative strength, and to me, it's just not really excited. Volume trends, not bad. And at least most of the selling here over the past couple of weeks has been on light volume. Need to get this breakout above 11.25. Doesn't look like we're going to get it at the open unless we pick up a little bit from pre-market action. So if we can get above 11.25, maybe we make a run. Otherwise, I think this one continues to consolidate. One other upgrade, JD.com. This one now you can see has broken out above prior highs. It is in the broadline retail group, which is broken out. And while it was doing all this consolidating, it pulled back on a relative basis. But this was a stock that was just at a 52-week relative high to broadline retailers. So when I look at this one to me looks much better than INFY, and I would agree with the upgrade. One downgrade I want to mention, ADS, and I've talked about this stock for a long, long time. It's in the financial administration space, which has continued to move higher. This stock has continued to move lower. On a relative strength basis, I can't think of too many stocks out there that look any worse, especially stocks that are in an overall good group. I mean, financial administration had put in its double bottom on a relative basis October and November, and recently moved to about a 4 or 5 month relative high, seems to be gaining strength, and yet the stock can't find anything to grab hold of. It's in a good market, it's in a good group, and the stock continues to go lower and lower. The downgrade here, I would agree with. I see nothing on this chart yet that would make me want to buy. All right, moving on. How about relatively speaking? What I wanted to mention here is that when I do my selection for my stocks that I talked about, the webinar that I'm going to do tomorrow, one of the parts of it is going in and looking at the industry groups to see which areas of the market are performing well relative to the S&P. I want that knowledge. If I'm going to try to beat the S&P 500, I need to know what areas of the market Wall Street is favoring. So I need to be looking through certain areas. Now, I can pull up a number of areas that maybe you already are familiar with. Semiconductors, of course, they've been on fire. This is their relative chart to the S&P. Here's their absolute chart. So they're going higher. The relative chart tells us that they're going higher faster than the S&P 500. So you take the index, divide it by the S&P 500 index, and that gives you a number, and then you plot it here. That's what StockCharts does for us. Anytime you use these relative price, where you use that colon between any two stock symbols, it'll give you the relative price action. Really important to watch this. I keep it on a 3-year weekly chart, all of the industry groups, so that I can quickly identify which groups are working and which ones aren't. So semiconductors are great. How about software? Of course, software's been great. How about computer hardware? Well, that's Apple. So of course it's been great. Apple, of course, this weekend did come out and warn about their revenues, however. So I did want to mention that the stock is a little bit under pressure. I'm going to give you see if I can give you this update in terms of their pre-market price. But yeah, Apple is definitely, hurting futures right now. Dow futures down 140, NASDAQ 43.5. So we are looking at some weakness there. And right now, Apple is down 7.75 pre-market. So it's down 2.4%. Not huge, but they cited the coronavirus and the effect that it's having on some of the stores in China that have closed. Obviously, you can't sell product if the stores aren't open. And they've also talked about their supply chain being impacted somewhat. And they did mention it was a temporary decrease in their revenue estimate. So it's not something permanent, but it is something that could affect the current quarter. Market reacting negatively, and of course, futures down as a result. Now, as I look at these various industry groups, some of them stand out and are easily, you can just spot them right away and say, yeah, that is a great looking group. I want to be part of it. And then you have others, and I'm going to bring up the broadline retail. I was just talking about broadline retail a minute ago with the upgrades and downgrades. But look at broadline retail. We're not breaking out to any new highs, but we have moved back up above both the 20 and the 50 week moving averages on a relative price action basis. The PPO, which is still in negative territory, is about to turn positive. This is a group that's looking much more bullish, but it's not as clear cut as some of the others I just showed you. And then another complete sector that I'm really taking a look at are the financials. What to do with the financials? Because interest rates, if we do get another Fed rate cut, interest rates are likely to stay low. That negatively impacts some areas of financials, but not so much others. So you see a group like property and casualty insurance, which had been, not a very good group the last quarter, but now all of a sudden starting to show strength. So all of these things go in as part of the consideration for what we're going to do at the webinar on Wednesday. But again, go to earningsbeats.com and check that out, get some more information. Hopefully see you at that webinar tomorrow. Let's move on to the 3 you must see. And we're going to start off with SurveyMonkey, SVMK. This is a company that came out with their earnings last week and absolutely blew the numbers off. Wall just blew away the estimates. And you can see this is a stock that had been consolidating for a long time. Made the breakout. Look at the volume. Very difficult to misconstrue the volume there. I think there's a lot of accumulation. It gapped up. It was not gapping up on the break. We didn't get the breakout on the open, but the stock did continue to move higher throughout the day. That type of candle to me is extremely bullish. When you open at the low of the day and close near the high of the day, you break out on this kind of volume. I don't think SurveyMonkey is done going higher. Doesn't mean short term we won't get a pullback, but I would be looking maybe around that 20 level near the open as your key support going forward. Next up, and the second chart I want to show you, biotechs. And we've talked a lot about biotechs, but I just want to talk about that Friday candle because it was selling off. Biotechs were selling off pretty hard on Friday. They got down as low as 21.79, rebounded almost a full percentage point to close back near that 2200 level. I am of the opinion that biotechs are on a roll to the upside. And if I'm right, this rising 20-day moving average, which is now crossed above the 50, should be excellent support on any selling. So Friday's move has got within probably 1% of that 20-day moving average. But if we were to pull back and hit that 20-day, I'd be looking for a rally. And our final stock today is IMGN. Just mentioned the biotechs. Well, here's a smaller one. Look at the breakout on Friday. Looking at a relative chart, you can see the breakout. Look at the volume, the biggest volume we've seen in almost a year. And look at the relative strength moving to new highs. These are the type of things that I'd look for. So IMGN is my number one stock or chart you must see. That's it for today. Appreciate everybody stopping by. Come see me on Wednesday. Happy trading.